All right, good morning, everyone, and thank you for joining us today for the WT Financial Group FY24 Results Investor Webinar. I am Dana Luca, the Investor and Media Relations Manager, and today I am joined by Founder and CEO Keith Cullen. Today we'll be running through the investor presentation, which was lodged with the ASX this morning, followed by a Q&A session. To ask a question throughout the presentation, please use the Q&A function, which can be found at the bottom of your screen. Keith, I will hand over to you.
Thanks, Dana, and thanks everyone for joining us. Well, I'm pleased to be able to present our indicative results for WT Financial Group Limited for the year just ended, FY 2024. Before we get started, Dana, if we can flip through to the disclaimer, please. You're probably all familiar with this, but anything discussed today is of a general nature only and does not take into account your personal circumstances or investment objectives, and you should seek your own professional advice. Look, we can probably help you with that, but for now, let's tip on to the next slide, please. All right, before we get going on the results, I'll take it as read that most of you online have an understanding of WT Financial Group and its business operations. But for those of you new to the company, I will just touch on it quickly. WT Financial Group is the ASX listed holding company of the group, and we see in this chart here the other key subsidiaries of the group. We have two distinct divisions, being our direct-to-consumer or B2C division and our advice network operations or our B2B division. I'll start first with the B2C division, albeit that it's much smaller than what it was a few years ago when we made the decision to pivot towards the B2B space. Operating under our Spring Financial Group brand, this is where the company started back in 2010. And as I say, our operations are a lot smaller today, but we grew that business to be quite a significant direct-to-consumer operation over the first 7 or 8 years of our life, and its services encompass the provision of financial advice and also accounting and tax services to both retail and wholesale investors. And it was our background in this area that had us identify what we saw as an enormous opportunity in the wake of the Royal Commission into the financial services and banking sector back in 2018. We identified what we saw would be coming as the unraveling of the vertically integrated model. And for those of you not familiar with that, is in the sort of decade or so before the Royal Commission, probably 15 years or so, in fact, before the Royal Commission, we had seen the banks and the major institutions like AMP and Insignia, as it's now known, the old IOOF, and also insurance companies, acquire a lot of advice network operations, as they were called then, dealer groups, and really use them as a means of distributing product. So after the Royal Commission, we thought this model was going to fall away really quickly. It probably unravelled quicker than even we thought it was going to, with the banks and now virtually all of the institutions exiting the space. But we thought we had a lot to offer to the advice networks that were going, or the advice practitioners that were going to be left without a home as all of those institutions exited the space. So across 4 years, we have acquired, starting with Wealth Today, then Sentry Group, then Synchron, and more recently Millennium 3, to consolidate what is now around 400 advice practices in those groups that collectively encompass around 600 advisors, inclusive of our both personal advice and general advice advisors. And these advisors deal with well more than 100,000 consumers who collectively have around $23 billion of funds under advice and around $400 million of in-force insurance premium that the advisors are looking after for those consumers. Now, these practices are independently owned and operated. They come in all sorts of shapes and sizes, from single advisor practices not really one-man bands, but single advisor practices might be a single advisor operating inside an accounting practice that also does fin planning, or a mortgage broking business or similar, right through to much larger corporatized practices, many of which are multidisciplinary with things like accounting and tax and mortgage broking and estate planning and so on. So each of these practices are licensed by one of our 4 cohorts of Wealth Today, Century, Synchron, or Millennium 3. And whilst we've kept those individual brands, they're B2B brands. So they don't cost us a lot to maintain, but we see it's very important to maintain those brands because each has a strong legacy within the profession, and many of the advisors have a tight affinity with those brands, having been with those groups for as much as up to 30 years, but many of them certainly 5, 10, 15, 20 years. So whilst we maintain those individual brands, we've centralised all of our processes under our Wealth Advisor centralised support hub. And at this stage, Dana, it might be a good idea to flick on to the next slide. And this really shows how we operate the business. So again, all of those brands sitting underneath, operating different cohorts of advisors, but everybody plugged in to a single centralised support hub. You'll see that we've been able to get great efficiency through this process, and importantly, consistency of delivery of services across the 4 cohorts. Now, the services that we provide to the practices range from licensing in the first instance. So financial advisors in Australia need to be attached to an Australian financial services licensee, and that licensee, being us or one of our 4 different licenses, becomes responsible for the conduct of those advisors. And in effect, the clients become, from a legal responsibility perspective, clients of the AFSL, albeit, of course, that the advisors are the ones looking after them on a day-to-day basis. So you can consider the AFSL model really in a manner of the regulator, ASIC, having outsourced responsibility for supervision of advisors within those groups to advice networks like ourselves. So what do we do for the advice practices in our network? Well, it's a lot more than licensing. We support their businesses in all manner of ways, and some of these are set out in this chart here. We support them with their professional development, providing them ongoing advisor education and training, and we support them with consumer engagement tools and client retention tools and marketing tools to help them grow their businesses. From a compliance perspective, we support them with an approved product list and a series of policies, our policy suite that sets out for them their legislative and regulatory requirements, and we help supervise them to that and help them manage risk around delivering services to ensure that they always remain consistent with those requirements. We also provide them coverage under our professional indemnity insurance program. Importantly, we collect all of their revenue for them, whether that's coming from product providers such as fees being deducted from superannuation funds on behalf of their clients, or whether it's commissions being paid by insurers, or whether it's consumers paying them directly. So we're collecting all of their revenue, helping them manage that process and remitting that revenue to them. We also have our own law practice inside the group that provides our advice practices the opportunity to be able to deliver estate planning services to their clients, and that's a very important emerging market for the profession. Most significantly, all of our advice practices and advisors within the group operate within our risk management framework, and this supports them with a peer review process that enables them to have all of their advice and files peer reviewed in real time as the advice is being provided to clients. So we don't rely upon this sort of annual in arrears process of spot auditing a handful of files and so on to help our advisors manage risk. We've perfected a system to, in real time, help them manage that risk and give them the benefit of that peer review process as and when the advice is being provided, so that any issues in terms of file integrity or, professional errors happen, any such things can be picked up before the advice goes out the door. And this is a very effective way to manage risk for both the consumers, most importantly, the advice practices, and of course, the business overall. So this is all centralized under our Wealth Advisor Hub. These sorts of services we do make available to advice practices that are not licensed by us as well, on a user pays or a subscription basis. Most critically, you'll see that next line down as we support our practices and the practice principals from a corporate perspective with practice management, helping them improve their efficiencies and profitability, and things like advisor recruitment as well. And what we're seeing increasingly important is the support that we can provide in the space of mergers and acquisition activity, and also succession planning as the profession becomes more corporatized. So look, that gives you an idea of how we operate. All of our practices pay us. We earn our revenue in a variety of ways. Our practices and advisors pay us base fees. They'll also pay a variable fee to be covered by our professional indemnity insurance program. That will vary relevant to the amount of revenue that they have, and they pay us on a user pays basis for assisting with things like their peer reviewing their advice in real time. Importantly, the majority of our practices we have complete alignment with, as we have revenue share arrangements with them. And this, of course, motivates us to assist them and enables us to invest in services and personnel to assist them in growing their revenue and profitability, and it rewards us in doing so. And importantly, as practices grow, obviously our liability associated with the amount of revenue that they're turning over grows as we're responsible for their conduct and their engagement with clients. So from a liability risk management perspective, we believe it's important for that alignment to exist. So that's a relatively short introduction of what's a very broad subject matter. I encourage any of you that are new to the business and considering looking at an investment in either ourselves or any other advice network in the country, that you reach out to Dana or Jane at JMM and organise a time, or contact me directly, or drop into the Q&A today that you'd like to take a deeper dive into the business, and we can organise a more in-depth discussion if you've got specific questions about the nature of financial services licensees or the market more broadly. All right, so with the familiar faces online, and for our existing shareholders that know the industry and the profession well and know the company well, let's flick to the next slide, please, Dana, and we'll have a look at the full year results. Now, I'll say that we published these the other day. They're indicative results, but we do not expect to see any material variations in the financial statements once they're published later this month, or the audited financial statements or the annual report once published, which will probably be early to mid-September for the annual report. So we have a high degree of confidence with these numbers. On this first chart, I just thought we would start with breaking the year in half. We published our first half results, obviously, back in February. And I thought before we sort of delved into the year-on-year results, it would be important to have a look at how the second half of the year played out against the first half of the year. We completed that little tuck-in acquisition of Millennium 3 in December. That was an opportunistic acquisition that we did when Insignia came to us and said they were looking to exit that business. We were very delighted to be able to participate in the process and ultimately complete that acquisition very late in the first half of the year. So for that reason, we thought it important to break the year into the two halves for everyone. So we're very pleased that the first half, if you have a look at it, had an underlying net profit before tax, I think, of just short of $2 million. And that increased to $2.5 million for the underlying business for the second half, delivering about 4.4 or thereabouts net profit before tax for the underlying business. So you'll see right throughout the numbers that we've presented to market the other day, and also this presentation today, that we're consistently referring to the underlying business and we've broken that out from one-off revenue and expenses. And I've done this going back across the last 4 years. Reason for this is I've copped a bit of criticism, or we have in the past, for not properly breaking out what were one-off income and expenses. That when we have a look back over the 4-year numbers shortly, you'll see we've generally had a boost from in each year over the last few years. So people were really wanting to focus on what's the underlying business doing, because this evolution or revolution really to being nearly purely B2B focused, that's what they're wanting to see. How's it working? Set aside the one-off stuff and let's see how the underlying business is going. The genesis of all of that, of course, is that for those who are not familiar with the company, from sort of 2019 year onwards, is we sold off a bunch of our retail assets, starting with our insurance business and our business to consumer insurance business, then our Melbourne clients, our Brisbane clients, etc. And we've also made acquisitions and picked up liabilities and picked up gains on contract along the way. So as we've been going through this sort of balance sheet and corporate restructure, is we've had all sorts of different non-recurring one-off revenue, and in some cases liabilities hit the P&L. Really, they have nothing to do with the underlying business and the future of the company. They're more sort of balance sheet items. So let's have a look again on the full year, looking at those numbers. I'll just pull this across the screen so that I've got it in front of me. Really pleased with revenue growth, up for the advice network, 32%. Half year on half year. Cost of goods sold up 33, GP up 20, underlying EBITDA up 18, underlying EBIT up 21, underlying net profit before tax up 43. And that jump in that period enabled us, when we moved to the year-on-year numbers, to deliver an increase of 50% on the underlying net profit before tax on last year. I'll talk in more detail later about those statutory P&L adjustments, but we had some income hit in the first half of the year, which was from the sale of a small B2C mortgage book that we had in the business, and then some one-off expenses associated with the M3 acquisition early in the second half. So net effect of those boosting the actual statutory net profit before tax by about 357,000. All right, now these charts really show the consistency of the growth over the last 4 years. Really looking at revenue up from a starting point of $13 million up to 185 million in this most recent year, going from a loss-making position in 2021, where we really started to accelerate that process of restructuring and started selling those B2C assets. We took some write-downs on goodwill and so on, and we were in a loss-making position in that year, through to 2022, moving into profitability, through to 2023, getting a really good boost to profitability, and now delivering this underlying net profit before tax increase of 50% in this year. So up across all those key metrics of revenue, GP, EBITDA, EBIT, and net profit before tax, 4 consecutive years straight now. So a pleasing result. So if we hop on to the next slide, please, Dana, this will break that down into numbers. And I'll just say that we've released this to the market today. So anybody that wants to grab hold of it off the ASX who hasn't got it yet, is they can go and grab this to have a deeper dive and contact us with any questions. But this shows that we've seen consistent increases again in both revenue and profitability across those 4 years. So each of the 4 years laid out, starting back in 2021 to the left, and then through to the right, 2024. The prior corresponding period comparables that you see there with the percentages on are 2023 to 2024, so the most recent corresponding period. And these have seen us in the underlying business have a 15% increase in revenue, GP a 17% increase, underlying EBITDA up 29%, and underlying net profit, as we said on the last slide, up 51%. So a really pleasing result. Having a look at the one-off income and expenses going back to 2021, you'll see we've broken those out for that year, and we had both asset sales and also hitting the revenue line from a one-off perspective, but we also had expenses there through restructuring costs on things like redundancies and getting out of leases, etc. 2022, we had further asset sales hitting from a positive perspective, and also restructuring costs and redundancies and so on. 2023, we had a big gain on contract associated with one of our acquisitions that boosted statutory net profit after tax by the best part of $2 million. So I think all laid out there on a statutory basis, net profit after tax will be impacted again by about $350,000 this year on a net basis, but considerably less than that sort of $2 million last year. So Dana, if we can move on to the next slide, as we'll have a look at the balance sheet now. And I think really pleasing has been, as we've embarked on this corporate restructure and been backed by our shareholders to do so, we've seen net assets have increased across those 4 years by nearly 400%. Now, that's against an increase in issued capital of just 68%. So we've raised capital and issued shares across that period of time to help us with this restructuring and acquisition strategy, but we've been able to effectively deploy that capital and see significant increases well in excess of the deployment of that capital in our net asset position. Across this time, we've assumed various liabilities associated with some of those acquisitions. We'd have detailed those at the time for those that want to go back and look at prior announcements as we've made those acquisitions and take a deep dive into them, or contact us again and we can step you through them. We've been able to fund out all of those liabilities that we assumed as part of our acquisition value, also fund out our back-end payments, such as performance-related upside payments associated with some of the acquisitions. Vast majority of that we've been able to fund out of cash flow, which has been terrific, and that's enabled us to start to position the balance sheet into really good shape. So looking at that balance sheet, you'll see that it's been a big turnaround across that period of time. We've been able to get through this entire restructuring process and come out the other side pretty strongly, we consider, with a very manageable and modest level of debt of just $6.7 million. So moving on to the next slide now, probably the most pleasing is that what we're seeing is consistent positive operating cash flow. And that's enabled us not only to fund things like those back-end payments and assume liabilities that I talked about a moment ago, but also fund this most recent acquisition of Millennium 3 that we picked up from Insignia throughout this year alone with $2 million of cash. In addition to that, so even net of that $2 million of cash paid out, as we've still managed to increase cash this year from last balance date by getting close to $3 million. Now, this was aided, of course, by very strong operating cash flow. So over $5 million of net positive operating cash flow. That's a terrific result for the company. When we from an investment perspective, is we had obviously that $2 million out the door. So if you look at the investing cash flow, we had the $2 million out the door, and then we obviously picked up the money associated with the sale of that mortgage book. So a net position of negative 1.7 from an investing perspective. And cash on the balance sheet as at the 30th of June, up to $8 million. Now, subsequent to the year end, we had what was now our final payment associated with any of our acquisitions, and we paid out $1 million in cash. Again, thanks to that strong operating cash flow. That was our release of a warranty lockup escrowed amount of money associated with our Synchron acquisition. So you could go back and have a look at prior disclosures for the details of that, but we had no need to tap into that warranty lockup that we had in place. So we were able to release that back to the vendors of Synchron after the balance date. Most excitingly, of course, it's put us in a position, even with all those investment-related cash flows out the door, given the strong operating cash flow, it's put us in a position to return to dividends. So next slide, please, Dana. That's fantastic. Well, let's just have a quick recap of the results. Underlying revenue and income for the year up 15%, EBIT up 41 to $5.2 million. Now, importantly, operating expenses year on year increased just 12.4%. And this is something that we've been very pleased we've been able to do through the efficiency of processes and systems that we've built in place to centralise all the delivery of services to our advice networks. Is as we've gone through these terrific periods of growth, is we've been able to really maintain a very tight rein on the operating expenses. And that's because we're not doing things 4 times. When we run things like our professional development days that we run around the country, we're not doing that 4 times. We're not doing one for Wealth Today and one for Sentry and one for Synchron and one for Millennium 3. We're bringing all of the advisors together. They're getting the benefit of a larger community to participate in, and we're delivering that very efficiently to them. And that same sort of model is how we run the entire business. So underlying net profit before tax up 51%, as we've talked about, and cash equivalents up 50% to $8 million, net of that $2 million out the door for Millennium 3. So the strong result represents the 4th consecutive year of compounding growth for the underlying business and provides for a return to dividends. Board's anticipating declaring a fully franked dividend between 0.4 and 0.5 cents once the audited accounts are finalised. Now, consistent strong operating cash flow has enabled us also to reinstate the policy to pay dividends biannually now that our acquisition strategy has been completed. Just a quick recap on those one-off expenses. I won't go over them again. That was the asset sale and some costs associated with acquisition. These will increase the net profit before tax. Statutory tax expense, we expect to see a bit of a leap in that over last year as well. Will be around $900,000, probably $935 is where we think it'll land. Now, interestingly, whilst we'll have that statutory tax impact, no cash tax liability will arise. The company has a franking credit balance of more than 1.4 million. So this will enable a dividend to be fully franked. We've got 339 million shares on issue and 1.5 million options, and no shares or options were issued during the period. We expect the financial statements and 4E to be out within statutory times, and audited financial statements with the annual report by mid-September. I'll reiterate, we don't see any material variances. So on to the next slide coming. Why are we so bullish about the space? Why did we get into this space? Industry tailwinds and the supply-demand imbalance are providing for significant upside. And whilst we are very pleased with what the executive team, staff, and also our advice practices have been able to achieve over the last few years, we really feel like now we are just at the starting gate. I think our results are reflective not just of our own performance and the practices in the group, but for a very positive future for all advice practices across Australia. Why is this? Advisor numbers have declined a little more than 15,000. And I'd have to say to you that our best estimates and those of others that we deal with are that it's going to be 2026, 27, 28 before new entrant numbers get anywhere near to matching the natural outflow of advisors who are retiring and looking to sell their practices. So whilst this decline in financial advisors has been occurring, the number of consumers in the core cohorts that seek advice and their capacity and preparedness to pay proper professional fees continues to grow. Now, between the last two census, the retiree market grew 19%. That's a 65 plus market. If you go and have a look at the ABS data, that is one of the core markets that really needs help. Superannuation, tax, and Centrelink laws and regulations are getting more and more complex. People's retiring balances and net asset positions are getting higher. People need help and they're prepared to pay for it. Now, a lot of them will be seeking advice around their superannuation. It's probably what represents 70% of the advice revenue pool would be advice associated with superannuation. Those assets are growing in Australia net by $2 billion each and every week. So the mass market industrial model for advice has been replaced with a narrower professional services model where advisors have been able to generate more revenue by dealing with less clients. So from our perspective, we'll continue to drive paradigm shifts in the licensee advisor relationship to further improve outcomes for practitioners, their clients, and of course our shareholders. And this will include things like what we're doing at the moment, but doing more of this, which is working with practices to further modernize their businesses, to better streamline and take advantage of technology in terms of generating business inflow, dealing with processes in their businesses that will help automate a lot of the compliance demands and client service demands in their businesses. And also, of course, increasingly important is helping them with corporatization initiatives. I touched on that earlier, but we'll be playing a key role in helping them facilitate their M&A activity and succession planning. And we really see this real push towards corporatization across advice practices over the next 5 to 10 years. And we're very excited about playing a leading role in that with our practices and also attracting practices from outside the group in doing that. So on to the next slide, please. I think that brings us to a conclusion. What I will say about your board is that the board of the company, that is myself and Guy Headley, Chris Colesis and Chelsea Pottinger, significant shareholder founders and a strong track record in financial services and in M&A in both private and public companies. And if we move on to the next slide, Jane, there for everyone, our key executive team is a hands-on executive team with significant shareholdings and extensive experience in financial services, both B2B and also B2C as practitioners. So it enables us in our thinking just to add real value to the advice practices in our network. Is we have walked and continue to walk a mile in their shoes, both sitting in front of clients on a day-to-day basis and knowing what it's like to run a practice on a day-to-day basis. Plus also we bring value to the table with them with our collective experience in M&A and that sort of corporatization process. And just showing, look, from a shareholder perspective, WT is founder-led, board and management have significant holdings, and additionally, we have a very strong register of experienced financial services investors who have backed the company, backed its vision to emerge as a significant player in this space. They understand this supply-demand imbalance in advice, and they understand that the demand for advice is not going away anytime soon as Australia's population ages and as superannuation balances and the net wealth of middle and upper Australia continues to grow. We've got names there at UIL, which is an ICM company, Ariadne, IFM, and of course some leading financial services executives in there as well that really understand this game and are there for the long haul and the future vision. So board and management has 95 million shares, top 10 holders 251 million, total of 339 million shares on issue. And that's a wrap from me for now. I know that Dana said she's had quite a number of questions already emailed through, which is great for people to do that. And also we'll take any live online now that we can get to. So there we go. Over to you, Dana.
Great, thank you, Keith. So yes, as we said, now to some questions. And again, we do encourage all attendees to use the Q&A function at the bottom of the screen. Okay, let's kick off. The first question. So you've mentioned a return to the dividend cycle with the intention to pay biannually. So what does this mean? And should this be considered an interim dividend?
Good question. Look, in effect, is if you go back to the half year, I think we were getting ready to pay a dividend for the half year, and we were confident that we were going to be able to pay a dividend for the half year and return to dividends on the half year result. But that opportunity came up from Insignia to acquire M3, and quite rightly, I believe, even as a significant shareholder that would have been keen on a dividend myself, is quite rightly we took the correct course of action and use that $2 million in cash to cash settle that transaction. So, look, technically this won't be an interim dividend, but I think it's fair enough to think of it like one. You can think of it as a half-year dividend more than a full-year dividend. But from a technical perspective, it'll be the final dividend, I think, under the listing rules. But certainly we think if you have a look back at that $5 million worth of positive operating cash flow for the year, we're delivering consistent growth as I think people can expect to see us in a regular cycle from this point.
Great. And next question. We have seen Insignia and AMP both exit the advice space. So why do you remain so bullish about operating in the space?
Well, look, they've exited recently, and they've been interesting exits because they were the only two institutions that hadn't exited. The banks had all run for the door back in 2018, 19. The insurers like Clearview and TAL and others that were operating advice networks had sold their advice networks off because they really saw that there was a happy coexistence between that vertically integrated model, producing product here and advising on product there. So, they were left with business models, I think, that were subsidized by that. I remember talking to a very large advice network 10 years ago or more, and the head of that was saying that they were losing $40 million a year. Really, what they were doing is subsidizing services to their practices and loading it up with a whole bunch of cost. You could say they were losing $40 million a year, but they were seeing about $400 million a year worth of product fees come out of that network. So it was a relatively small cost of goods sold, was one way to look at it. Now, the difficulty that I think the institutions have had as the whole space has professionalized and we've got rid of that vertically integrated model is they've had that difficulty in trying to completely throw out their business model and start again. And they've decided that sort of getting out of the space was the easier way to do it. I'm very excited for all of these emerging advice practices, ourselves and others included, that have come in with a fresh slate and are able to build relationships with their advice practices that are founded on a genuine partnership relationship that respects the advisors, that respects the advice that they give, that is focused on helping them grow and manage risk within their businesses. So I think they're chalk and cheese, the types of operators. We're bullish for all those reasons I said before, just those supply-demand dynamics.
Great, thanks, Keith. The next one has come through a few times. There's been a lot of consolidation in the space. Do you think there will be more consolidation in advice networks moving forward?
Look, there could be. There's no question that scale is really important in running these businesses efficiently if you want to have that genuine partnership and services suite available to the practices that you support. To be able to fund things like, a team of people that know what they're doing around M&A activity that can help practices access capital and access debt, to have the operational wherewithal, to have the not just this license for rent sort of approach, but to really understand how to manage risk within the business, to have personnel that have walked the walk themselves. It's expensive, but it's very scalable. To do advisor professional development and education and training is expensive. We would spend the best part of $2 million a year on our professional development programs and advisor education and training. Now, whether you've got 150 people in the room or 500 people in the room, that number's probably about the same. You need the right level of scale. So I think there's room for further consolidation, probably down the ladder a little bit to those practices with 50, 100, 200, 250 advisors in them. I think they'll start to look for how they can get some scale into their businesses.
Okay, and next one, what do you think your key advantages are over your competitors, and how will you drive organic growth if the focus is now not on acquisitions?
Look, I mean, I think our key advantages are living and breathing it and placing advice at the center of everything we do. I mean, every decision that we make inside our business, every step that we take in terms of supporting our practices is done through the lens of a practitioner who knows what it's like to sit in front of clients on a day-to-day basis. The provision of advice isn't something that sits over here as far as we're concerned. The provision of advice is what our business does, and our focus is to help advisors deliver advice, great advice in a timely manner that's commercially viable for them, that delivers outcomes for consumers, and that will appropriately withstand scrutiny, both community scrutiny and regulatory scrutiny, and that will be best of breed. That is this business. That's at the center of it. Everything else we do is seen as subsidiary to that, whether that's supporting with M&A activity to provide more scale, whether that's supporting with advisor education and training, whether it's supporting in process and efficiencies and technology inside their practices. The only reason we're doing any of that is to facilitate the delivery of great advice. And so that's how we structure our business. That's I think our point of difference, in terms of our competitors more broadly. I think one of the advantages that we have, I know that a lot of our competitors went to fixed fees with their practices a few years ago. In fact, we've got some fixed fee structures within our business. Not unhappy with the amount of revenue that we're getting from those practices on fixed fees, but the vast majority of ours we share in revenue with. And I think that's a big advantage for both the advisors and also for us as a business, because it enables us to invest in their growth. We get them to have more revenue, we share in it, we get them more profitable, we become more profitable. It's just a virtuous circle. And I think it's the best way to align ourselves, and also for us all to align ourselves from a risk perspective. So that's probably a point of difference.
Okay, and again, another one that has come through a few times. What do you see as being the key risk to investment?
It's really interesting, Dana, and that's a great question. There's literally hundreds of millions of dollars of investment being attracted into the Australian market from offshore private equity funds and investors wanting to invest in advice in Australia. And that's fantastic. And we will help our practices with that process of matching that capital up with their growth plans and so on. But I say to everyone in this space, there's one big risk to investment in this space, and it's exactly what is attractive from an investment perspective at the moment. So it's a dual-edged sword. And the dual-edged sword is that supply-demand equation. So right now we're riding this fantastic wave of a supply-demand imbalance. It's not great for consumers, because a lot of consumers are being disenfranchised. They can't afford advice anymore because advice is kind of moving up the value chain, and advisors are getting to deal with people that really can afford to pay and really value and get a lot out of their services. So that imbalance is working terrifically and will work terrifically well for our business for several years to come now. What we need to do in the meantime is fix the inflow of new advisors. And so this is what all of network operators and our profession more generally and our associations need to work with government on over the next few years, is to make sure there's someone to sit in front of these clients in 5 years' time, to make sure there's someone to buy these assets in 10 years' time. Because otherwise, having a whole bunch of trucks and distribution facilities without drivers, you haven't got much of a business. But look, I think that will get fixed, but it's what I keep highlighting as the biggest risk to that sort of long-term 5 to 10 year horizon So we all need to stay focused on fixing that from a regulatory and legislative perspective.
Great, thanks, Keith. Next question, what is the most impactful trend you see in advice in Australia, and how will you either benefit or face the risks of that trend?
Interesting. Well, the most impactful trend for advice would be this moving up the scale to advisors dealing with less and less consumers. And so, look, we're taking advantage of that most definitely through our revenue share arrangements and through working with our advisors for them to get paid more for their professional services and their advice. But there is a risk there, though, that you disenfranchise too many consumers, and we end up becoming a profession that, you know, if you lined it up against the legal profession, we end up all being KCs or all being senior counsel. You know, there is a need for a broader profession, and one of the ways to mitigate this risk and to also really take advantage of it is the other big trend, which is technology. And so the big emergent technology is not just relevant to the advice profession, but it's relevant to everybody. You know, AI or artificial intelligence or whatever you want to call it is providing enormous opportunities for practitioners to become a lot more effective with their time, to give them more time available to sit in front of clients. So, you know, we're all really focused on getting practitioners dealing with the right number of clients to start with, and then getting them more efficient using technology to deal with more and more people. Get that average number they're dealing with up from around sort of 120 to 140, 150. You know, it is halcyon days ahead. There's no question, thanks to those two trends.
Okay, and just cognizant we are running out of time. So finally, what should investors look forward to over the coming 3 to 6 months from a news flow perspective?
Look, I think that cash flow is looking good. So I think, you know, what they can look forward to is a return to that dividend cycle, I think, importantly for us. And I'd say I get it. You know, people have been reticent to step into the stock over the last few years because it's been a long time since we paid dividends. And we've been very thankful to have a very supportive shareholder base that understood the process and was prepared to invest in that restructuring and our acquisition strategy. With that, and so they weren't, you know, banging down my door insisting on dividends, because they understood it was an investment and rebuilding period. With that done now, I think it answers that important question for everyone, and I think we've been able to demonstrate that the cash flow's there, and we're really happy.
Great, thanks, Keith. So that's all we have time for today. If we have missed any questions, I do encourage attendees to reach out via the contact details on the bottom of our ASX releases, and we can organise a meeting with Keith and the team. So thanks again, and we look forward to hosting you again next time.
Thanks, Dana. Thanks everyone for joining. And if we missed a question or anything that you wanted to touch on today, we look forward to hearing from you.
Thanks, everyone.